Hello, everyone. Welcome to this final panel session of the second day of the Greenwich Economic Forum. My name is Alice Fulwood. I am the Economist Wall Street correspondent, and I'm delighted to be hosting this panel today, where we will be asking some of the world's top deal makers from private equity and venture capital about their views on the economic outlook and the investment landscape. We have just heard from investors in various industries about how they have been coping with the COVID-19 pandemic and investing this year. We're now going to hear from some people involved in the sort of deal-making side of the industry and how their portfolio companies have been doing. It's obviously been a very tumultuous year, which has given investors a lot to consider, both in terms of keeping their existing portfolio companies alive and in terms of seizing opportunities that this crisis may have presented. I'm delighted to be joined to discuss deal making by Steve Case, who co-founded AOL in the 80s and ran the firm until its merger with Time Warner in the early 2000s. He has since co-founded Revolution, a venture firm based in DC, which partners with entrepreneurs to build durable businesses. Hello, Steve.
Great to be with you.
Great. We're also joined by Jill Granoff, who is the CEO of Eurazeo Brands, a division of the investment firm Eurazeo that focuses on high-growth consumer and retail brands. Prior to joining the firm to found its brands division in 2017, Jill was the boss of Vince, a successful retail brand which she took public in 2013. Hello, Jill.
Hi, great to see you, Alice.
Very glad to have you both with us today. Before we get into the topic of sort of 2020 and how that's affected both of your investment portfolios and your firms, could you just both take me through your investing strategy and what your sort of investment goals are at your respective investment firms? Steve, why don't you go first?
Sure. We launched Revolution, as you heard, to back entrepreneurs across a variety of different sectors, and it's evolved, particularly over the last decade, to be much more of an institutional firm. We now have Revolution Growth, which is sort of the flagship, investing in the growth stage opportunities. Revolution Venture is more of a classic kind of Series A investor, and also a seed fund called the Rise of the Rest Fund that's focused particularly on backing entrepreneurs outside of some of the coastal tech hubs like Silicon Valley. So we've made a number of investments all around the country, very U.S. Focused. And what's I think a little different is partly that place focus, but also we believe the next wave, what I've called the third wave of the internet, policy is going to become much more important. Many of the sectors up for grabs are going to be disrupted. There is sort of a government regulatory aspect to it, healthcare, food, agriculture, things like that. And partners are going to matter as well. So it's not going to just be creating a cool app and getting viral adoption and figuring out how to monetize it. It's going to be much more complicated. The technology in some ways will be the table stakes, and the real value will be created around how you forge the partnerships and how you navigate on the policy side. So that's really the focus at Revolution, and we try to back entrepreneurs because we're in seed, venture, and growth at every stage of the entrepreneurial journey.
Great. And Jill, could you take us through your focus at Eurazeo?
Sure. So Eurazeo is a global private equity firm with 20 billion in assets under management. We basically have a dual funding strategy, both investing from the balance sheet as well as third-party capital. We invest in a number of different asset classes, so traditional private equity and buyout, but also growth equity, where I focus, as well as venture capital and private debt. Eurazeo Brands specifically has been seeded from the balance sheet, $800 million to invest in high growth, differentiated brands in beauty, fashion, home, wellness, leisure, and food. Typically, our investments range from 20 to 100 million, average check of about 50 million. And again, we look for differentiated brands, especially those that have a strong digital angle.
I imagine that sort of digital angle from a retail perspective has been very important in 2020 because depending on whether you were sort of a brick and mortar retailer or a digital one may have affected the trajectory of your firm quite significantly. Could you talk a bit about how your different sort of retail investments or your different investments have fared this year and whether their sort of performance has surprised you in any way?
Look, I'm really pleased to say that 7 of our 8 portfolio companies are actually up to last year. And so in some cases, although the brick and mortar stores were closed, we were able to quickly accelerate our digital momentum. Think about slingshot momentum. We replatformed websites. We had digital capabilities. We altered our marketing strategies to leverage social media. We focused on within our assortment strategy those products that would be really relevant to customers during the pandemic, and we were able to accelerate growth. So in some of our companies, even though the stores were closed, we're seeing triple-digit growth on the e-commerce side. I think a large part of this is that our companies focus more on needs than wants, and we're certainly seeing a shift from discretionary to staples. So food and bev has fared very well, activewear, home fragrance, anything that's capitalizing on the premiumization or casualization trends. But I have to say, we are behind in many cases to our original plan, which are often quite aggressive. But 7 of our 8 companies are up to last year, many showing double-digit growth.
And Steve, I guess the instinct would be that tech companies in general, i.e. sort of your portfolio companies, might have been doing sort of better in 2020. Has that been the case for you? How have your investments fared?
Yeah, we've actually been like everybody when things first hit, I guess now 8 months ago, we had to take a step back and then kind of review where things were. And there were, going into this pandemic, some concerns. We've actually been really surprised and delighted that so many of these entrepreneurs have really done a great job in under difficult circumstances, either seeing an acceleration in their core business because of some trends or pivoted to capitalize on new opportunities. A couple of examples: we had 2 companies go public in the last few months. One in the sports tech sector, DraftKings, I think it's now the most successful SPAC of all time. We also had a e-commerce platform company, BigCommerce, go public. That offering has also been quite successful. They've really seen some headwinds, particularly on the commerce side, because of the e-commerce has spiked so much in the last 7 or 8 months, and even consumer habits have shifted. We have some retail companies like Sweetgreen, a fast casual restaurant that had to shut down its restaurants initially, but accelerated their efforts around delivery, expanded their menu, and now they're showing real great momentum. Clear, which many people may know in terms of airport security, how you get to your plane a little bit faster. They've also expanded with a health pass, really capitalizing on some of the opportunities in this space. Scopely, which is a mobile gaming company, has seen a real acceleration. I guess when people are home more, they're playing more games, and they've seen great growth there. Tempest, a company we backed that was focused on big data, initially on oncology, trying to better diagnose and treat cancer. They've also had a big effort in the last 6 months around COVID testing, so seeing acceleration there. So we've really been quite pleased by the momentum we're seeing. Some of these trends, like certainly what's happening with e-commerce, are going to continue. We also have seen some trends around telehealth. The company we backed, Talkspace, is focused on digital mental health. They're seeing record growth in terms of what's happening in their business. So the pandemic obviously has had some terrible aspects, certainly in this country now, with nearly 250,000 people dead, and lots of people, millions of people really lost jobs that are not going to easily get recovered. But there has been a silver lining, and we've seen some of that, particularly in our Revolution Growth portfolio.
And obviously, over the past couple of days, we've had this news that Pfizer's vaccine is particularly effective, and you've seen a reversal, at least in public stock markets, for some of the valuation premiums that you'd seen on companies that were going to do that were sort of assumed to do well, like the tech companies. And I wonder, this sort of raises this question of how durable are the various trends that we've seen in 2020. Particularly, I guess you both sort of have experience in e-commerce. Steve, why don't you go first? How durable do you think some of these shifts are?
I think most of them are quite durable because they have not just been kind of technology enabled, but fundamental consumer shifts. And once people start doing things differently and see the convenience of that, they're likely to continue to do it. And we also expect that in some of the industries that are regulated, like telehealth, where they've relaxed some of the regulations, most of that will stay in place because people are realizing it actually works well, and the patients and the doctor or the therapist is able to provide a great service with more convenience, often at a lower cost, by embracing these technologies. So in most cases, I think these will really be permanent changes. As you mentioned, there's been some slight reversal of some stocks, but like a Zoom and a Peloton, I think we're up 500% over the last 8 months. So having them pull back a little bit is not that surprising. Those trends, though, I think are still going to continue to move forward over the coming years.
Yeah, I
Jill.
would totally reaffirm what Steve has said. I mean, we've seen sort of three key trends. One is digital, the second is a focus on health, and the third is a focus on home. And we think that these are sustainable trends. So from the digital perspective, whether it's telemedicine, we have an investment in a company called Doctolib, which has done phenomenally well. To digital fitness, we have an investment in a company called Bandier that's offering fitness classes at home. But look at Lululemon buying Mirror, or look at the growth of Peloton. People have made a $2,000 investment. They're not about to walk away from that. I don't know that people are returning to gyms that quickly. So definitely think that the digital trend will continue because people are starved for time, and this offers enhanced way. From a health perspective, obviously, there's been growth in healthcare, but there's also been growth in health and wellness, both what you put in your body, what you buy on your body. And we think that will continue as well, whether that be supplements, whether that be, body care, skin products. And I think also just healthy eating. We have certainly focused on health praise. I saw, drinking before, he was drinking a sparkling water. We just invested in Waterloo, a flavored sparkling water company, as people are moving away from, carbonated, sugar-infused beverages to more healthy alternatives. So we have made investments there as well. And then finally, home. I mean, people are working from home. They're cooking at home. They're entertaining at home. We think that those trends will continue. You could hardly find, a bicycle or a desk or try to get a refrigerator. I mean, it's incredible. But we do think that people have become accustomed to the convenience. We don't think that everyone will be returning to work as quickly. And we think that home is a category that will also continue showing growth in the future.
The other thing I think is really going to be interesting to watch in the next few months and even few years is not just what's happening in terms of technology, but also what's happening in terms of talent. This ties in with our thesis, The Rise of the Rest, where we believe this next wave of companies will be spread more broadly around the country and around the world. And Silicon Valley, while it'll continue to be the leader of the pack for sure, will not be as dominant in the internet third wave as it was in the second wave. We've seen in the last several decades a real brain drain from many parts of this country, where people felt if they wanted to be part of the innovation economy, they needed to go to the coast, particularly go to Silicon Valley. And as a result, venture capital has followed that. And last year, 75% of venture capital went to just 3 states, California, New York, and Massachusetts. So the other 47 states got 25%. We think that's going to change. We've been working on this for a number of years, but the pandemic has been a kind of an accelerant there, because a lot of people, both entrepreneurs and venture capitalists, have decided to go somewhere else in the country and shelter, initially expecting to be temporary there, but some are now deciding to stay there. Some companies, certainly Facebook and Square and others, have decided to adopt very flexible remote work plans. So a lot of people are going to decide to relocate either to someplace they originally were from, or maybe someplace they went to college in, or some other reason. And as that happens, and we see the kind of the brain drain of talent slowing, and even a boomerang of people, we think that will result in more startup cities rising around the country, and more breakout, iconic, multi-billion-dollar unicorn companies all across the country. So that, to me, may be one of the most enduring trends around this pandemic to watch. Not just, like I said, the technology or specific sectors, but what happens in terms of the flow of talent.
And how do you take advantage of that trend? Is it that you would sort of seed companies in a wider range of cities than you had done in the past, or is it the way that your portfolio companies are targeted, that you'd be more interested in an e-commerce company or someone that can distribute sort of nationwide? Sort of how do you take advantage of that trend?
Well, as I said, there's 3 different funds we have. Both Revolution Growth and Revolution Ventures are backed by institutional investors, kind of a classic list of great institutional LPs. When 3 years ago we launched the Rise of the Rest Seed Fund, we decided just to go with individuals, and some people, including folks who some are involved in this conference, who are investors in our Rise of the Rest Fund, include Ray Dalio and Henry Kravis and David Rubenstein and Jim Breyer and John Doerr and Jeff Bezos and Howard Schultz and Tory Burch and Meg Whitman and several dozen others. Some of the most prominent entrepreneurs and investors in the country really joined us to make these investments in these cities. And because it's a seed fund, our initial checks tend to be around $500,000. We've made 150 investments in 70 cities. We're seeing remarkable momentum in terms of what's happening with that portfolio. Some are moving into the growth, and even kind of some looking at going public. So we've been pleased to see that. And because it's a place-based strategy, we are seeing trends in different cities really developing. And some of these industries I mentioned that are kind of up for grabs, like healthcare, while of course San Francisco, Boston, New York have great healthcare institutions, some of the most important influential medical institutions are like the Cleveland Clinic in Ohio, or MD Anderson in Texas, or Johns Hopkins in Maryland, or the Mayo Clinic in Minnesota. And some of the most important companies in that space, like United Health, is based in Minneapolis. So that we think will drive this rise of the rest trend, will drive more opportunities in these other places. And the way we source these deals for the Rise of the Rest Seed Fund is in partnership with regional investors. So far, we have over 300 regional investors we've co-invested with the Rise of the Rest Seed Fund. And as these companies scale, obviously, we're able to provide the later stage capital they need through Revolution Growth.
Jill, could you talk a little bit about some of the ways in which the pandemic has provided opportunities for you this year? I know you just mentioned that you'd made an investment in a sparkling water company. Was that something that you were able to do because of the way valuations moved, or because of sort of the new trends that you saw emerging, or how have opportunities sort of presented themselves this year?
Well, actually, within Eurazeo Brands, we've closed on 3 deals in the last 3 months. Some we have been in discussions with for a long time. Others were new. I think the biggest difference is that we are different from many other private equity firms because we truly are value-added capital. I spent 25, 30 years building brands in retail and beauty and fashion, and that has become increasingly important, especially to entrepreneurs and management teams, and especially in the face of adversity. They want to have a trusted partner by their side that can help them evaluate the trends, set priorities, build teams and capabilities for the future. So I think that we have been able to do a lot of deals because we're different, not only the value-added capital, but we have permanent capital, as I mentioned previously, and also our global reach. So as people think longer term, I mean, we have 10 offices on 4 continents. We have a 100-year history. So I think that people are really looking for who is that reputable, trusted partner that can help them, not only in the short term, but also in the long term. And one of the things we've talked about with all our companies is the need to play offense as well as defense. Of course, when the pandemic hit, it was, yes, shore up the balance sheets, turn your inventory to cash, collect your receivables, all the things that you would normally do. But very, very quickly, we said, okay, now we have to focus on innovation. Let's really study the consumer. What do they need? Best support those needs. And I think that's why we've not only been able to do deals, but accelerate the growth of the companies that we have. So I think it's really a combination of these factors, but being a value-added partner is now more important than ever. And even certain entrepreneurs that in the past didn't want to take capital in, they don't want to go it alone. They really want to have someone by their side. And I think this is where, Eurazeo's long history, the support we have, CSR has become increasingly important. Companies focused on, sustainability, clean beauty, inclusion. We provide a lot of support and resources to help companies achieve their mission-based goals.
Steve, is that something you've seen as well, this enthusiasm for entrepreneurs to have a partner now in a way that they possibly didn't in 2019?
Yeah, no, obviously as entrepreneurs are scaling their companies, capital is part of it, but the other things that investors can provide to help them on this journey, I think becomes even more important. And there's more of that flight to quality, if you will, related to that. And I think some of this goes back to, at least what my view is going to be this next third wave of the internet. Since I was involved in, as you mentioned, the introduction and getting the internet going when we started AOL, which was 35 years ago this past summer, only 3% of people were online, and those 3% were online an average of just 1 hour a week. So it was the early days, and we really wanted to get America online, get the world online. That was the first way, building the on-ramps, the servers, the modem farms, everything, and creating the reasons why people wanted to get online. That did require partnerships in a very significant way. We had 300 partners at AOL to really make it possible. It required dealing with policy issues. Actually, when we started, it was still illegal for consumers or businesses to actually be on the internet. It was still restricted to government agencies and educational institutions. So the partnership policy was critically important there. In the second wave of the internet, really the last 20 years, companies like Facebook and Google, because in that first wave, you built the internet, the opportunity was then to build on top of the internet, which really became mostly apps, mostly on smartphones, and some of these enormous successes happened. Interestingly, they really didn't need partners to get going. they didn't really need to navigate policy to get going. Now they have some policy challenges, but to get in the market, that was not really a factor. As we enter this third wave, which is when I think kind of the internet meets the real world, partnership and policies become much more important. It's not just about what you build, it's how you figure out ways to go to market. How do you build partnerships and alliances around your company, and how do you navigate some complicated policy issues, some of which might slow your growth, others with change in policy could accelerate your growth. When we talked about some of those earlier, DraftKings, part of the reason it's really seeing a lot of momentum this year, including when it went public, is because some changes in some of the regulations around gaming that opened up opportunities. Talkspace has seen changes around telehealth regulations that has resulted in acceleration of that growth. So in this third wave, when partnerships and policy becomes more important, the capital that investors provide, I think, will be increasingly viewed as sort of the table stakes, the value add in terms of helping build these companies, particularly around some of the subtleties of this third wave, is really going to be, I think, where the rubber meets the road. That's certainly how we're positioning Revolution, not just trying to be another investment firm focused on seed, venture, and growth, but with this bias towards place, rise of the rest, partnerships and alliances and policy, what we call the 3 Ps. We think those will really be the drivers in the next 10 or 20 years.
When you are both thinking about sort of potential risks to your views or potential headwinds, I mean, I know that policy definitely could be a headwind or a boon depending on the sort of specific company, but what are the sort of big headwinds or risks you're thinking about for 2021? Why don't we go to Jill first?
Well, look, I think the news on the vaccine was tremendous, but it's going to take some time to be rolled out. So I think the first half of 2021 is still going to be slightly challenging, especially for retail dominant businesses. I mean, even think about now, stores have reopened, but people are not rushing out to stores. We see traffic down, although AOV, average order volume, is up for people going to stores, but people aren't rushing out. So I think for 2021, I think the first half of the year, is still going to be challenging. I still think we have to be cautious. I think the back half of the year, if the vaccine gets rolled out when it's said, will be better. Obviously, some of the other headwinds, unemployment rate is now, twice the level it was pre-pandemic, 7% versus 3.5%. I think the economy has been slightly bolstered by some of the stimulus checks. So there's been a lot of bankruptcies. So we just have to be cognizant of that, which is why our strategy to invest more in staples versus discretionary items, I think will help us at Eurazeo overall. For example, food and bev, we have to eat. Pets, we love our pets, and people are not going to, stray away from that. Skincare, healthcare, I don't see people not investing in that either from a consumer perspective. So we just have to stay focused on staples versus discretionary, digital over physical. And I would say the other thing is we are now more focused than ever on profitability and cash flow, not growth for growth's sake. I think in the past, people were looking at high growth companies and, we were not big, supporters of the more you grow, the more you lose. That has become even more critical now. And obviously, there are many publicly traded companies that are doing well. But I would say for our companies, given the stage that we're at, we are looking more at profitability and cash flow to ensure that we can sustain 2021. Because again, we see the pickup coming more in the back half of the year than the front half of the year.
Steve, how do you think about the sort of same headwinds?
I would just echo much of what Jill said. I think it obviously depends on the sector, and because we are invested in a lot of different sectors, it's going to vary. Some are seeing great momentum now, which I think will continue, and that will continue into the first half of next year. Others, there likely will be a little bit more of a lag before things kind of return to some semblance of normal. But I think what's great about entrepreneurs, I certainly lived this myself as an entrepreneur, but then for the last decade plus, backing a variety of different entrepreneurs, is they're so resilient. They always figure out some way to kind of break through, and they did have to hunker down initially with the pandemic and figure out what that meant to their companies, but then they quickly moved out of that managing hunkering down mode into more of a imagining what's possible, kind of going where the puck is going, and that's where we've really seen so much momentum. I do believe that will continue into the new year. I mentioned some of the examples, like Clear. Who would have thought when essentially all airlines had shut down, a company that's primarily focused on the airline business would have such a great year, but they did because people expect to fly again, and they have also pivoted to focus on this Health Pass, partnering with the Sports League. One of our partners here at Revolution, Ted Leonsis, is one of the sports owners and quite influential in the sports world. And we've seen a lot of momentum around how do you reopen, whether it be sports or concerts or office buildings in a safe way. So a company like Clear said, start playing again, said, let's use this as an opportunity to really accelerate and expand our business. And they're looking to, for really, expecting quite significant growth over the next couple of years as a result.
Great. I think I'm just going to do one more question from me, and then I'll start taking some questions from the audience as well. So anyone who's watching, if you have any questions that you'd like to ask Steve or Jill or both of them, please do distribute them in the usual way, and I'll try to get to them. But I guess one more from me for now. Obviously, in addition to the sort of tumult of the pandemic, 2020 has also seen a sort of reckoning in terms of racial inequality as well. And I was wondering how, sort of for both of you, you sort of think about that in terms of either the firms that you invest in or the firms that you buy, or how those firms sort of interact with society in the world, and whether that's affected your investments at all. Why don't we go to Steve first?
No, I do think it's important that as we think about innovation and entrepreneurship, we think about leveling the playing field so everybody everywhere who has an idea has a shot at building a company, sort of a shot at the American dream. And that's sort of an underpinning of what we're building at Revolution, in particular focus around the Rise the Rest. But we recognize this year we need to do even more. About 45% of the investments we made out of that Rise the Rest seed fund are women founders or Black or brown founders, which higher the industry average, but still lower than it should be. So we launched an initiative that's going to roll out in early December. We've done a lot of bus tours around the country as part of Rise the Rest, where we visited dozens of cities and tried to do what we can to strengthen the startup communities, identify promising companies there. This time we're focusing on Black founders, and we put out a call for pitch applications just about 6 weeks ago. About 500 companies applied to pitch, and we're going to have the 5 top companies pitch on December 3rd. And we've now have more than 100 venture capitalists all around the country who are joining us as part of this virtual tour, this equity edition tour, we're calling it. And they've all agreed to meet with some of the founders and provide guidance. And hopefully that will lead to many of the companies, not just the 5 who are pitching, kind of getting capital and getting issues they otherwise wouldn't have had. So that's an effort to try to expand capital. I mentioned earlier that 75% of venture capital goes to just 3 states. So from a place standpoint, things are a little bit broken. If you look at it more from a kind of a faces, not just places standpoint, last year, over 90% of venture capital went to men, less than 10% to women, even though 50% of our population in this country is women. And last year, Black Americans represent about 14% of our population. Less than 1% of venture capital went to Black founders. So we can do better. We must do better. And it's not just a problem to solve in terms of equity fairness, although there's an aspect to that, obviously. It's really an opportunity to seize. It's because we believe in this third wave, some of the greatest entrepreneurs are going to be people who bring different perspectives from different places to bear, and some of these challenging issues around healthcare and other sectors that are going to change. So we're really leaning into this in a big way, and we're trying to build alliances, partnerships to allow us to work with many venture capitalists in many parts of the country to try to create more equity, whether it be around place or around race and face.
Yeah, and to build on what Steve is saying, I'm really proud at Eurazeo. We have just launched an initiative called O+, and the goal is to have a 0 net carbon footprint by 2040. We have 430 companies within Eurazeo's global portfolio, so we really are looking at ways to reduce carbon emissions, not only at Eurazeo, but in each portfolio company. And in addition to that, we're very focused on gender diversity and inclusion on every one of the boards of our portfolio companies, among staffing, et cetera. So it's a very, very big focus for us. I think part of this stems from the fact that we are a listed French company. The rules in France are slightly different. For example, our supervisory board, 40% is mandated to be women to ensure that we have, the variety of thought. Funny situation, true story. I have a company in my portfolio called Nest New York. They do home fragrance. They're doing phenomenally well during this environment. And I remember when we were having our review, and I was like, okay, we're going to score really well on this one because we have so many women. And actually, we failed. We had too many women and not enough men. So we had to actually reframe the board to ensure that we had appropriate diversity, gender diversity, and obviously we want to have, broad-based ethnicity as well, so that we sort of marry our consumers. But, I'm very, very proud to be part of Eurazeo and this O+ initiative and the team that we have in place to really drive CSR, again, across our 400 plus portfolio companies.
Great. Okay, so I'm going to take a couple questions from the audience now. The first one I have is for Steve. One of our participants want to know, why did you hit the road to locate entrepreneurs in tier 2 or 3 towns when you set up your latest fund, instead of waiting for partnerships and policy to come to you?
Well, we learned, my own experience I mentioned with the early days of the internet, early days of AOL, if you're just waiting around for things to happen, you might be waiting a long time. It's better just to kind of lean into it and really try to do what you can to catalyze action. And some of this work got started for me about 10 years ago. I was asked by President Obama to chair an initiative called Startup America. It started exposing me to some of the differences in terms of what's happening in different places and some of the opportunities that came out of that. That led to things like the Jobs Act that changed some of the rules around capital formation, made it easier to go public, crowdfunding, things like that, and then led to us to launch this Rise of the Rest effort about 5-6 years ago. And it's really been remarkable since we've now visited 44 cities, Detroit and New Orleans and Minneapolis and Atlanta and Phoenix and really all over the country. That it's remarkable what's happening in these cities. They're starting to show momentum around startup formation. The cities are starting to, including the mayors and governors, are starting to pay more attention, not just to existing businesses, but helping formulate new businesses and create a stronger kind of startup sector. And as we've seen this more and more, we decided then to 3 years ago launch the Rise of the Rest Fund, as I mentioned, in partnership with some of the most respected founders and investors in the country. And we really do believe we're onto something. We really do believe that the fund will generate top tier returns, surprise some of the coastal investors, and we're already starting to see more and more of them look to follow us as these companies scale and do some of the later stage investing. So it was a journey for me, gone from being an entrepreneur focused on building the internet to then launching Revolution and building an investment firm. But as I learned more about some of the dynamics in terms of some of the opportunities out there that were untapped, we decided to be much more focused. As investors know, I'm sure everybody on this call knows that the way to do really well as an investor is not do exactly what everybody else does, but have a slightly different theory of the case and kind of lean into that. And that's what we're doing around the strategy of Rise of Rest around place, as well as this third wave dynamic, as I mentioned before, where we think partnerships are going to be critical and policy is critical. So we've built up a team that focuses on place, focuses on partnerships, and focuses on policy.
Great. I have a question for Jill now as well. Jill, do you anticipate consolidation in sectors such as FMCG or retail as they face headwinds that can be more easily weathered by larger firms?
I think we're certainly seeing some consolidation today, and in other cases, we're just seeing more collaborations. I think it was interesting that it was announced this morning, Target and Ulta partnering together in order to capture traffic. Ulta is going to be establishing shop-in-shops in Target locations. I think that you will see more and more of these types of collaborations, that are going after the same customers, and 1 + 1 = 3. In other sectors, you will see consolidation. Certainly, we do see some of the major real estate firms that are buying up some of the bankrupt companies, and what are they going to do there? So I think that we will see some consolidation, but at the same time, I think the pace of innovation is also increasing. And that's one of the reasons why Virginie Morgon, our CEO, made an investment in a company called Economist in 2018 to focus on venture, to focus on tech. We've seen huge growth with Economist. We actually just completed 100% buyout of that last month. So yes, on the one hand, you will see consolidation. I think troubled businesses, are troubled. They may close. There may be consolidation or bankruptcy, but I think great businesses, there's still very, very high demand. And I think there's a lot of innovation to, address the pandemic and changing consumer, shopping habits and demand patterns, and we're going to see much more in the VC world. And again, that's one of the reasons why we made the investment in Economist to diversify our asset classes beyond just traditional PE into VC, growth equity, and private debt.
Thank you. And one more from the audience, for either of you or both of you, if you'd like. Do you think late-stage tech companies are becoming an asset class of their own? And do you think we'll see more growth in venture buyout?
Well, this is right up Steve's alley. I think he should go.
Okay. No, I think it's amazing to see it just in the last half century what's happened in terms of venture capital, which started as really a fringe idea, has become much more mainstream, and not surprisingly, it's now kind of segmented where there are folks who focus on seed, focused on venture, focus on growth, and the dynamics there are different. We decided to organize with separate teams, separate funds, because we really do believe the challenges and opportunities at each of those stages are different. You are seeing on the late stage side a lot of things in the last several years, a lot of innovation, some from large funds like the SoftBank Vision Fund has pulled back a little bit in the last year because they've obviously stumbled with some investments, WeWork and some other ones. We've also seen the advent of the SPAC market really this year, which had been previously focused on relatively slow growing kind of middle market PE companies, and now are backing a lot of growth opportunities. I think the market's looking for growth, and they're looking for recognizing that the future is going to be different in some of the most important aspects of our lives, as mentioned, sectors like healthcare and learning and food and agriculture, things like that are change a little bit in the first wave of the internet, change a little bit more in the second wave of the internet, but are going to change a lot in the third wave. And healthcare alone is the largest industry, about 20% of our economy, and it hasn't changed that much yet, but will, and that then creates a lot of opportunities. So the companies that really understand that, build the right teams, establish the right partnerships, navigate the right, kind of policy, issues, are really well positioned to grow. As a result, there is more capital focused on the companies that have moved from that startup phase to much more of a speed up phase and really have the potential to be gigantic changing companies that have multi-billion dollars, in some cases tens of billions of dollars of valuation. That's why there's more attention to this. But I do think it's important, as I said earlier, that the entrepreneurs look for investors that, of course, are going to write a check to provide some of the capital to fuel the growth, but also be helpful in recognizing that the game around innovation is changing, the roadmap for entrepreneurship is changing, and the skill set to be successful in this third wave is changing, and have investors that can help them as they navigate some of the challenges, but also some of the opportunities this third wave will bring. That's obviously what we're trying to do, particularly with what we've built with Revolution Growth.
Yeah, we see an acceleration as well. I mean, take Farfetch. It was one of our early investments. We came in very, very, that went, from venture to IPO. And I'm sure you read recently that they're partnering with Alibaba. So, in the past, it used to be, okay, let's do VC and then growth equity and then PE and then maybe some to a strategic. I think all the rules, you can throw them out the window. Obviously, the strategics are looking for growth, so they're dipping down sooner, investing earlier stage. But you also have venture companies that are going public earlier, and then just also digitally native companies. Look, yesterday's announcement of VF investing, $2.1 billion to buy out Supreme. So that, is just incredible. So I do think that the rules of the road are changing. And the key is to be able to provide a competitive edge, which is what I think Eurazeo does well with its global reach, its 100-year plus history, and the team members that can provide value-added capital on a global basis to help accelerate growth and drive value creation.
And one more question for you, Jill. I guess Eurazeo Brands is, you were sort of, before you were at Eurazeo, you were obviously an actual sort of retail CEO. Sort of how has your perspective changed being an investor versus being actually in the industry?
Well, I have to say it's a lot more fun. I mean, I've run 2 public companies. I've been involved in 3 IPOs. I've sat on a number of boards. I love working with early stage founders, plotting the strategy, driving growth. Look, I became a public company CEO in 2008. That was not fun, when all of a sudden open to buy dollars are being cut. You have to close stores. You have to lay off staff. I mean, that is not fun. I love focusing on growth. I love focusing on strategy. I have 30 years of experience. Obviously, I also respect what the founders bring to the table. And together we can, help it move the businesses forward. And I think that's why, as I mentioned earlier, 7 of our 8 businesses are actually up to last year. So I think the operating experience I've had really positions me very well to do the job that I'm doing now. I think that's why our pipeline has been so robust. I mean, 25 years, in beauty and fashion and wholesale and retail and digital, and global. I've kind of done it all in that regard on the consumer side. So I think it's been really, really helpful. And this job is the perfect job at this stage of my career. And I'm proud that in 3 years, people never heard of Eurazeo in the States. We were able to, build awareness, build the team, build the pipeline, build the portfolio. We've deployed 400 million of our 800 million in capital. That's not easy to do. It's very competitive out there. There is a lot of dry powder. There's a lot of pent-up demand. How are you going to differentiate yourself? So for me personally, I think being able to work alongside founders, which I've done in my whole life, Leonard Lauder, Les Wexner, so many other people, to be able to take those skills and help accelerate growth has really been, an honor for me to be able to share the knowledge and also to learn to move businesses forward.
Great. I think we just have a couple minutes left. So last question for both of you. If there's sort of one lesson you've learned in 2020 to take into deal making next year, what is it, and how will you be applying it going forwards? Let's go to Steve first. Oh, no, Jill wants to go first.
Well, I think...
Oh.
Sorry? Well, Jill, why don't you go first?
We'll go to Steve. Oh, sure.
Yeah, I would say the most important thing that we have learned is the importance of people. Okay, you can have a vision, you can have a strategy, but if you don't have the leadership and the management team to implement and execute those strategies, you will never drive the results. And in the past, we might look at sector dynamics. We might look at brand positioning. We might look at growth levers. We might look at financial performance. How are they growing? What is the margin? How many followers do they have? At the end of the day, the number one learning, the most important thing is people. People that you obviously share values with, but people that have the capabilities to execute the strategies. People that are nimble, that are adaptable, that can move quickly to take advantage of change. And as I said earlier, play offense as well as defense. So going forward, we're going to look very, very closely at the management teams of our portfolio companies and ensure that the capabilities are in place to execute the strategies. That's not to say we can't hire talent. It just takes longer. If you bring in a new CEO, who brings in a new CFO, who brings in a new, head of sales or a new head of digital, et cetera, we want to back proven management teams and then give them the resources, not just capital, but the operating expertise and global muscle in order to deliver results. So for me, the biggest learning, most important learning is the importance of backing strong leaders and management teams.
And I would agree with that. Certainly my own experience with AOL, when we started with a couple dozen people, then it was hundreds of people, then it was thousands of people, then it was tens of thousands of people. The lessons you learn as you move into every chapter are a little bit different, and you have to make adjustments, including the team. Entrepreneurship is a team sport, but the team you need at that early seed stage is different than the team you need at the growth stage, and you have to be able to recruit the right people. Obviously, one of the things we try to do with the companies we back is be helpful in terms of helping fill out the teams and make sure they're positioned for this next wave. The other thing I would say is remembering that you have to go where the puck is going. You have to lean into the future, not just focus on where you are today, not just focus on kind of playing defense, but playing offense and having a theory of the case in terms of what's going to happen, irrespective of what your sector is, and really kind of lean into that in a major way and recognize, as I said before, that the game has changed, and it's not just about what you do, it's the partnerships and alliances you form around your technology, around your product, around your company to really get it scale, and how you navigate some of these policy issues, which I think are going to be very complicated. I think there's going to be a growing backlash against big tech, a lot of issues, not just in Washington, but in Brussels to deal with over the next decade as technology becomes a much more central part of everyday life. Last point I'll make is quoting Thomas Edison, who I think is one of America's greatest innovators, greatest entrepreneurs. Over a century ago, he said, vision without execution is hallucination. So having a big vision is critically important, but executing it's even more important. And that does require exactly what we're talking about. Great teams that can set the right priorities and have the right passion and really having a perspective about what's going to happen next and positioning the company to really lead in that next chapter.
Great. Thank you both so much. So you need to have a vision, lean into the future, and have the right people to get it done. Thank you both so much. Thanks, Steve. Thank you, Jill, for your time. That is all we have time for today. We are going to go to some closing remarks, and then that will sort of wrap up the Greenwich Economic Forum for day 2. Thank you both so much.